Hello, everybody. Dr. Richard Smith here with the Foundation for the Study of Cycles and Cycles TV. Good to be back with you. Thanks for your patience over these last few weeks as I've worked through a number of really innovating projects, which I'm excited to share some of that with you today. And I'm also excited to share with you that our conference in New York City is coming along smashingly. We have 20 presenters of world-class quality and only about 70 seats total available to the public. So between staff and board members and presenters, that's 30 seats out of 100. And there's only 70 seats. So you can be in a room with 20 major influencers and thought leaders in the world of cycles with us in New York City. So I think we're getting close to being sold out, but there are a few seats left. So do check it out. You can go to cycles.org. I'm sure somebody will probably put a link in the YouTube feed here, but it's going to be amazing. John Bollinger is going to be joining us. Lars and John Bollinger are going to be doing a little show together on YouTube. I think it will air next week. So really looking forward to that. I'm hoping that Lars might cook up something revolutionary for Bollinger Bands and how we could integrate cycles parameters into Bollinger Bands like he did with the RSI. So incredible stuff happening. I know Lars is on fire lately. And excited about all of that. So meanwhile, the world is not stopping. It's not holding still. It's not waiting for us on hold while we do all the work that we're doing. So the world continues to move along. So what I am going to share with you today, I've called it Oil and the Market Tides. So as you know, for the last couple of months, I've been spending a lot of time in the archives, working on the cycles of war and on Edward Dewey's original long cycle studies, the 54-year cycle, and a number of long data series, and really looking back at how was cycles analysis done? What were our founders thinking? What were they after? You know, we are so focused on financial markets these days because let's face it, you know, the financial sector of the economy has become a much bigger sector of the economy since Dewey was doing his work. So it's not surprising that so many of us would be focused on the financial sector, and rightfully so. But there is more to cycles analysis than just the financial markets. And looking back into the archives and studying how Dewey and others were approaching cycles analysis back 50, 60 years ago has been very interesting. And one of the things that's really alerted me to or made me more aware of, I always knew this was going on, but really spending time in the archives has driven it home. They were really looking at what cycles are working together across different assets, right? And asset classes and categories, like what's the relationship between tree rings and sunspots and wheat prices and war cycles and geomagnetic data and the stock market, right? So that is really looking for what are called coupled oscillators, things that are oscillating together, that are coupled together. And the simplest and most striking example that we have at hand about a coupled oscillator and how coupled oscillators work is how the sun and the moon produce together through their gravitational pull on the earth what are called the spring and the neap tides. So twice a month, there are high water marks on a tide gauge measuring how high the tide comes. And twice a month, there are low marks on the tide gauge. So the spring tides are at the new moon and the full moon. And the neap tides are at the first quarter and third quarter moons. So I'm going to show you how that works using a slightly different approach to cycles analysis than I think you've seen before, but I think you'll find it very interesting and illuminating. And then it'll open up some questions about how could we think about what's going on in markets, for example, with oil today, given the war in the Middle East. What is oil coupled to, and what is likely to happen to the things that oil is coupled to? So that's the question that I'm going to be exploring today. But I'm going to start by first sharing with you some visualizations that I've developed to help understand how the sun and the moon interact and how we can to produce the tides. Okay, so here we go. All right, so hopefully you can all see this now. Let me just make sure. Where'd you go? There you are. Okay. So what we are looking at here let me start down here, okay? So this will probably look familiar to you, right? This looks like the charts that you usually see on the Cycles app, a composite cycle. But what this composite cycle is the influence of the sun and the moon's gravitational forces, which have different periods on the tides. And you get high tides at the new moon. You get spring tides at the new moon, spring tides at the full moon, and spring tides at the new moon again. This cycle is 29.5 days total. And then you get neap tides, low tides, at the first quarter moon and at the third quarter moon. So I'm going to get into exactly what this is. But if you think think about, let's say you have you're standing at, a pier in the ocean, and you're going to measure how high up does the tide come, what's its maximum and what's its minimum on that pier. That's called a tide gauge. And this is essentially measuring the height of that tide gauge. It's highest when the moon and the sun are aligned at 0 degrees, and then it's lowest when they're in opposition. It's highest again when they're aligned again on opposite or at 0 and 180 degrees, etc. So that's represented here by these two vectors. Okay, so the solar influence is this orange vector, and the lunar influence is this blue vector. Okay, and when you add them together, you get the how strong is their coupled influence. And in this case, they're both aligned, so they are amplifying the result at the spring tide, right? And over here in the neap tide, you've got them in opposition. They're at 90 degrees relative to the Earth. And so the impact on the tides is reduced. At spring tide, again, they're aligned and the impact is maximum. At neap tide, they're in opposition and the impact is reduced. So this is using, don't get scared, but the complex numbers, right? Have you ever heard of I, the square root of -1? So this is what happens when you're dealing with complex numbers, and complex numbers tell us about rotation, magnitude, and angle or relationship here. And they go around the unit circle here. And this is how you model the gravitational influences of the sun and the moon on the tides, and how you get this cycle line here. So I think this is very helpful to understand how cycles really work, and to understand more how cycles work together to generate the lines that we see in our application, right? If I go over here, I was just finishing up a little list for us to look at today. I'm going to add dry bulk shipping. I think it's BDRY. Okay, add it to the oil couplings. I'm going to close this. All right. So here is a simple analysis, cycle analysis on oil. And the strongest cycle here is 164 days. Not surprisingly, all the cycles are stretched on oil right now. Yes, you're seeing some new widgets that are, and scoring systems that are part of our work that we're developing for the conference. This has not been released to the public yet. We are working with it ourselves and refining it. But this is part of what we're going to be bringing to the conference and announcing at the conference and making available to others at the conference. So here we have, for example, I think that we've been focusing on the 61-day cycle in oil here. And you can see, you know, when you add cycles together here, right, you get these composite lines. And that's essentially what we're also looking at in the spring and neap tides here and how that is modeled. So to just drive home this approach to cycles analysis just a little bit more, because I think it's very important to understand this idea of phasors, they're called, and how how oscillators get coupled and work together. So here again we have the moon vector here and the sun vector, and then we add them together. And when they're aligned, you can see, you know, that that is kind of at its maximum. So let me just step through a little bit, okay? And as they kind of turn up, you can see that they're still pretty aligned. They've got a 3-degree difference now, and the gauge is reading at its highest level. Okay, I'm going to slow this down quite a bit, and I'm just going to play it a little bit, and we'll watch this go around. So over time now, you can see that the angular relationship between the moon and the sun is changing, and the sun is kind of not contributing as much to the pull on the tides. And so the tide height is going down, right? So this is the spring tide here, but as the sun and the moon get into opposition to one another, they reduce the pull on the tides. And you can see there in opposition, when they get to full opposition, when the sun is kind of working against the moon, we're almost there. That'll be right about there. Okay, so now the sun is actually in opposition to the moon and reducing the overall effect of gravity, the combined gravity of the sun and the moon on the tides. And that's a neap tide. And then it will carry on, and then it'll start to not cancel out the moon's effect on the tides and start to contribute, even add to it as we work our way back to the spring tide. And in this case, the spring tide there's the new moon spring tides when the sun and the moon are on the same side of the earth. And then there's the full moon spring tides when they're on opposite sides of the earth. And they both are called spring tides. So we're almost there to the next spring tide, which is right about there, if I go back a step, 0 degrees. So now they're in alignment with each other again. All right, so let me stop there for a minute. So I think that's very interesting to understand how two oscillators, right? The sun and the moon are both orbiting, or the earth. Let's just say they're orbiting around the earth, okay? They appear to us to be orbiting around the earth. And when they're, both at 0 degrees together on the same side of the earth, they're combining their gravitational pull. And when they're actually at 180 degrees opposite each other on either side of the earth, the full moon, they're also maximizing their gravitational contribution to the earth's tides, right? And the tide gauge is just a number measure that you can make at any moment in time, right? On this day, it's this, on this day, it's that, on this day, it's the next thing. And that's what we're usually seeing on our charts, our cycle charts. We're seeing a scalar measurement, a one number measurement, a one number outcome over time. But the story behind the tides is that there's actually two things going on that are generating that one number. And those two things are the sun and the moon and their gravitational influence and their angular relationship to each other. So that's very interesting. And as we think about, okay, here we are with war in the Middle East, spiking oil prices, we can think about oil has a cycle, right? It has cycles. Those are oscillations. So the price of oil oscillates. And it's coupled to other markets. It's coupled to China. It's coupled to natural gas. It's coupled to maybe bulk shipping costs. And so how might the spike in oil impact other markets that it's coupled to? How might the changes, it's sort of like if the sun, changed the strength of its cycle or changed its cycle. The thing about the tides and the sun and the moon is that they're just fixed, right? They don't vary over time, but markets do vary over time. And so we can ask ourselves, is there something here we could learn about the markets if we study a market that's changing like oil? And what might it be coupled to, and how might the change in oil impact its coupling to other assets? So that's the question that we're going to continue to look at a little bit today. Hope everybody's following me so far. Let me know if you have any questions. Let's see. Take a quick look here. Hello, everybody. Thanks for saying hello. Appreciate it. And Dancing Shiva says, in traditional yogic philosophy, the human energy system matures over 84 years. Sounds like the average lifespan or the fourth turning number. Silver represents the moon and gold the sun. Based on this, the correct ratio of gold to silver is 12:1. Interesting. Solar maximums and sunspot activity is directly correlated to global unrest, wars, etc. We've been studying that, Dancing Shiva. Hopefully you've seen my Cycles of War presentation, and that is something that I'm continuing to work on. I think it is a very important topic. So, all right, I just want to make sure everybody's tracking, and now we're going to go a little deeper, and we're going to start to actually look at oil and its relationship to other markets. Here we go. All right. So this is, I think, kind of incredible. I built this morning. Part of the incredible new tools that we will be unveiling at Cycles in the City 2026. Be there May 28th to 30th if you want a deep dive that you're not going to get anywhere else. So this is taking that same idea of two coupled oscillators, in this case, the moon and the sun producing, when they're kind of aligned, they produce higher tides. And when they're in opposition, they produce lower tides. So over here, I know this might be a little hard to see. So let me just zoom in here a little bit, okay? So here we have oil, USO, right here. And then these, that's XLE, energy, ITA is defense, natural gas, copper miners, and gold. And just like we can look at what's the relationship between the moon oscillator and the sun oscillator, are they amplifying each other? Are they in resistance to each other? We can also look at the relationship between, say, oil and natural gas. And right now, they are pointing in opposite directions, but notice like that's actually, I think the, that they're at 180 degrees and that they're actually synced up strongly, which means they're kind of amplifying each other, like when the sun and the moon are at 0 degrees and 180 degrees. So if we just watch this, let me scroll back in a little bit, okay? Over time, let me reset. Okay, slow it down. So right now, oil has made a big move and it's leading everything else, right? And we can see that over here in this chart here, where oil is the orange line here. And you can see the cycle has peaked in oil. And the cycles that are related to that dominant cycle in oil have not peaked. But if they continue to follow their cycle patterns, we'll expect them to peak a little later on. And then here is oil peaking again. This is a 61-day cycle in oil. And these things that are coupled to oil are likely to peak later on if they follow their relationship with oil that they've been following so far. So that's the idea. We've got oil, gold, XLE, UNG, copper miners, defense. There's a few more that I've been looking at as well. And so let's just watch how these relationships with each other are predicted to change over time. You can speed it up a little bit here. And you can see, like here's oil and natural gas kind of lagging a little bit, but pretty synced up with oil. There's gold and oil in opposition to each other. All right. So there's a lot more here that I am still learning about and exploring. And we'll go look at some specific cycles now. But I just wanted to show some of these new tools that we're working on to help deepen our cycle, our ability to use cycles to understand what's happening in markets. So hopefully you find this as interesting as I do and as exciting as I do. I think this is a major advance in our ability to leverage the study of cycles to understand our world better. It's not really, I mean, this is old math, if you could call math old or new. But I think we haven't really applied it to just our approach to cycles analysis as much, because we've been focused more on kind of a single asset, a single time series, like in this case, oil, and looking at the cycles of just that time series. But how do cycles interact with one another, just like the moon and the sun interact to produce the tides? You know, could oil and natural gas be interacting to impact the XLE, the energy sector ETF? So those are the kinds of questions that I think we can begin to explore when we think about cycles more from this point of view of coupled oscillators, just like the sun and the moon affecting the tides and gravity. And how can we begin to use these cycle analysis and identification capabilities to think about cycles in a new way? All right, so going back to the current state of things. Okay, so I made this chart here, or this table, using our beta new scoring system. And we can see that oil has a very negative score right now, very bearish. All the cycles are extended and turning over, especially, you know, this was, what is today? Today's the 8th. So I think this was as of yesterday, right? On the other hand, defense is up quite a bit. China's up quite a bit, or the cycles are bullish, I should say. And we'll go now and look at some of these individual situations. So in oil, we have this 164-day cycle and the 61-day cycle on the negative side of the ledger. You can see them clearly on the spectrum, 164 and 61. And those are, you know, for daily cycles, those are probably about as long as we want to look at. And we can see that, boy, the momentum is off the charts, right? This move from January 8th up to April 6th was exponential. The momentum is way off the charts. It certainly turned over a bit, but pointing down. And if we look at, for example, natural gas, it's got 175 and maybe 89 here, 335. It is not as negative as oil. And if we look at kind of what's been the relationship between natural gas and oil, right? So let's go back to the beginning. All right, they've been kind of in opposition to each other right now. If we go look at the cycles in natural gas, say this 89-day cycle, for example, right? It's pointing down, whereas in oil, the 61-day cycle is probably the closest there. We really haven't seen the same explosive move in natural gas, in UNG, that we've seen in oil. So is there going to be a change there? Looking at the coupling between oil and natural gas, we would expect that over time, we would see more of a following of natural gas. I think that's the blue one here, right? Peaking later than oil. Here's the oil peak. Here's the natural gas peak. If this coupling plays out, then we would expect to see natural gas rising more. All right, so we're about at the 30-minute mark here. Let me just check in on your questions, and then we'll look at a few more charts before we wrap up today. So what about a commodity trading index like DBC or DBA? Good questions. We can look at those. And again, this is research in progress right now, okay? So thanks everybody for wanting to learn and supporting the foundation in this work to study cycles and learn how cycles can tell us more about our world. And your questions are appreciated, and I will continue to dig into them. I can see the basic principle, but I haven't yet understood what the input parameters in the phasor wheel are. Are they the dominant cycles for each asset? That's basically what we've done so far, Dandy, is just use the dominant cycle. But I think that's an area of further research, is how do you choose which cycles you'd want to look at for the couplings? Which cycle links give you the strongest couplings between different assets? And how can we get a better sense of that, more accurate couplings to explore how this approach to cycles analysis might help us more. All right, so going back now to some more cycles. Let's see what's happening. China here is showing extreme bullish. So China's been coming out of a correction into a pretty strong cycle bottom for the 76, 109, 48, also bullish. Even this 83, okay? Those are all fairly bullish, and we've got a significant cyclic RSI buy signal there on China. We add in the cycle swing momentum, that's also up. So China looking pretty interesting, and lots of debate going on right now about China versus the US in terms of who's the winner, so to speak, in the war in Iran. We'll see. It's above my pay grade to understand all that. But China, certainly potentially a beneficiary from the disruption in the short term. And we've got a buy signal clearly from the cycles showing up in that asset, which is coupled to the price of oil as well. What else? Defense. Okay, this is ITA and ETF. And pretty interesting here, right? So for our bullish case, we've got multiple cycles bottoming 40, 80, and 89. Lots of harmonics there, right? And for the bearish case, we've got really just the one long-term cycle, 331. You can see it out here. But we've got a significant buy signal on the cycle momentum right there, which kind of diminishes the bullish case for that longer-term cycle. So if we go here to the 40, 80, and 89, you can see, all of these bottoming with the momentum buy signal there in ITA at a cycle bottom, and outweighing the bearish case from the falling longer term cycle, and also very coupled to oil. So defense, China so far, coupled to the price of oil, coupled to what's happening in the Middle East, and showing, I think, significant bullish signals from the cycles. Somebody asked about DBA. We can take a look at that. And DBC. So the number one cycle there, we have the cycle RSI, cycle swing momentum. Okay, 174. Definitely have momentum rolling over, which isn't great. Not really what you want to see on the longer term cycle. So even though it's bullish, and it's probably showing here as one of the bullish cycles, 174, doesn't have the strongest score because the momentum is not really supporting the up move in the rest of the cycle. Whereas the bearish case here, it's revolving around kind of 35. We could even add in the 75. I'm not so sure about these lesser cycles here, but momentum turning down, a couple of significant cycles, 35 and 75, even 63, pointing down, kind of the bearish case outweighing the bullish case on DBA. And DBC, what's happening here? Okay, there you are. Come on. All right, DBC had a pretty much all those cycles are negative. Very strong bearish case. What is DBC? Commodity index. Okay. So that, I guess it's different than the agricultural index. It's the general commodity index, right? And we have seen those. Obviously, there was a big move up, from February into April, but they look like they're turning over. The 157, 91, 41, they're pretty much all rolling over. Momentum's rolling over, and the cycle swing momentum is quite negative as well. So not looking great for DBC and DBA. The other hand, defense, China, dry bulk shipping, energy in general. On the bullish side, gold, copper miners. On the bullish side, natural gas, neutral, but mildly bullish. So that's what we're seeing. That's what I'm seeing so far. Very good. All right. So summing up, we looked at how the sun and the moon, 2 cycles, right? The moon, I think, is, I think the sun is 12 hours and the moon's like 12.42 hours. So they're slightly different in their cycles. And so gradually they kind of come closer into, together, amplifying each other, and then sometimes in opposition. And that impacts the tides and produces a, up and down line, just like we see on our cycles charts there, that is produced by the sun and the moon interacting to influence the tides on the earth. And so can we take that same coupled oscillator paradigm and apply it to how we understand the markets? So we are looking at oil and asking how What else might oil be coupled to? Defense, yeah. Commodities, yeah. Shipping, yeah. China, yeah. And looking for those couplings and then studying the couplings and seeing if they're uncoupling, are they getting more strongly coupled? These are the kinds of questions that I think we can ask. So early stages in this approach to cycles analysis, but I find it very exciting and interesting and satisfying, that we're not just looking for the cycles in a single asset, but we're trying to understand how things really work together. You can, just measure the tide heights and predict the tide heights just based on the data that you get measuring tide heights. But if you know that the sun and the moon are working together to produce the tides, that's some new information. And there are things about that you can use that you don't get just from the tide height alone. If nothing else, an understanding of what's really happening. So that's the idea behind this oscillator approach, coupled oscillator approach to analyzing markets and what's happening in the markets. And that's one of the many things that I've been working on in preparation for our conference in New York City. I do hope you'll join us there. Larry Williams, John Bollinger, Michael Howell, of course, myself, Lars, other board members, Andy Pancioli, Bill Cerubi, et cetera, et cetera. And it's just going to be an incredible gathering. Elliot Prechter will be joining us again, and Chris Carolyn will be joining us, Spiral Calendar. So please do come to New York City if at all possible and join us. I really think it's going to be an incredible gathering. And Lars and I are both looking forward to sharing some just incredible new work with you. So thanks for joining us, everybody. And I will see you again, hopefully, next week. Have a good one.
Cycles matter because they show us the future. Nothing else shows us a future path. Nothing that I've ever found in over 60 years of doing this.
The foundation is bigger than markets, right? It started out bigger than markets. It's still bigger than markets. It's bigger than us.
There is no such thing as a black swan. It is merely a cycle that was not forecast or anticipated.
To me, it's huge. If I can get a glimpse of the future, just a little bit of the future, I'm way ahead.
I think that the Foundation for the Study of Cycles has a role to play in both bringing technology to the world, but also really emphasizing agency and human agency.